Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. The Federal Reserve left its key rate unchanged in the 4.25% to 4.5% range at the end of its January meeting after 3 consecutive 100 basis point cuts. The markets expected this decision, so their attention was focused on signaling the prospects for further moves. The Fed continued to tighten its rhetoric, removing any mention of inflation, moving towards the 2% target. Later in the press conference, Powell said that we need to see more progress in reducing inflation and the actual impact of rates. Premature action in this situation may not be effective. The dollar index, as well as key dollar pairs, have been near their 50-day moving averages for over a week now after the USD weakened. The Fed has moved into a wait-and-see mode for the real effects on the economy from the policies of the Republican Party and President Trump. In the short term, the USD market is also waiting for signals from the economy. Maybe traders will see dollar volatility only after the publication of NFP data for January, scheduled for the 7th of February. U.S. indices opened the week with a sharp collapse. The news media unanimously attributed this decline to the strong results of DeepSeek, a Chinese competitor of OpenAI's ChatGPT. The news that a strong network can be trained on obsolete NVIDIA chips at 10 times lower cost pulled sales of the entire sector, led by NVIDIA. Last year's AI leader is struggling to regain momentum. The markets overall are now gently recovering. The Nasdaq 100 recovered 90% of its opening loss to the low point, managing to quickly bounce back into the area above the 50-day moving average. This is an important signal of the continuation of the trend from September. The S&P 500 closed Monday's gap up and is trading above 6,100, just 0.5% above the all-time highs. The latest dip may have worked as bait for those waiting for lower prices to join the rally in stocks. Recent data shows that, once again, retail investors are active in the market. The Dow Jones surpassed the 45,000 mark, entering the area of all-time highs. The steady rise in this index has been almost uninterrupted since the 13th of January, indicating a shift in stock market favorites from the big techs to the more classic large corporations and banks. Gold has hit record highs, moving into territory above 2,800. Strong buying following the November-December correction suggests the end of the correction phase and the beginning of a new growth cycle. A breakout to new highs activates a Fibonacci expansion pattern. The fundamental upside momentum in gold started in October 2023 and formed a peak at the end of October 2024. This was followed by a correction to 76.4% of the initial rally, which is typical of strong bull markets. The formal technical target now looks to be the $3,400 per troy ounce area. This is more than 20% above current levels, but is achievable in the 2 to 4 quarter time frame. The crypto market has increased by 0.4% to $3.57 trillion over the last 24 hours, but is still 1.4% below last week's levels. Cryptocurrencies are slowly and rather erratically climbing out of the dip they fell into on Monday. The market remains sensitive to negative news, but is recovering cautiously, avoiding excessive optimism. The sentiment index on Friday reached 76. It is the highest level in the last 2.5 weeks. Although the absence of clearly expressed FOMO may not please the bulls, who are hoping for a quick profit like previous bullish cycles, such an ascent is often more sustainable in traditional markets. On Thursday, Bitcoin exceeded the level of $106,000, but by Friday, it once again rolled back closer to $104,000. This decline indicates the caution of players approaching historical highs. It seems that many prefer to fix profits near the peaks over the last few weeks. The new week will focus on the U.S. labor market and the UK rate decision. On Tuesday, the 4th of February, the focus is on the new US job opening statistics. The indicator's fall over the past 2 years was viewed with alarm, but the figure has stabilized in the region of the 2019 highs. A rise would be a strong positive signal. Wednesday, the 5th of February, sees the release of ADP private sector employment data. This is the closest indicator to Friday's NFP. The indicator has been adding at a slightly below-trend pace in recent months. But so far, the labor market as a whole has not turned around. Surprises can't be ruled out here, though. On Thursday, the 6th of February, the focus is on the Bank of England's key rate decision. Markets are expecting a 25-point cut. The central forecast is for 2 more cuts within a year. Signaling a change in this expected trajectory will be the main driver of UK markets. More declines will increase pressure on the pound. On Friday, the 7th of February, all eyes are on non-farm payrolls. Often markets are quiet, going into a waiting mode a day before the release. The last couple of months have seen growth rates above the trend of 200,000, also working to strengthen the dollar. However, strong data can also trigger a sell-off in stocks. Stay tuned to Pro News Weekly for more updates on global markets. Like, share, and subscribe.